Hi there, tax accountants. I hope all is well, and I pray that as you're viewing this video, that you're in the best of health and spirit. This video will cover Chapter 1, Individual Income Tax Return. By the end of this chapter, you should be able to explain the history and objectives of U.S. tax law, describe different entities subject to tax and reporting requirements, apply the tax formula for individuals, identify individuals who must file tax returns, determine filing status, and understand the calculation of tax according to filing status, define qualifying dependents, calculate the correct standard or itemized deduction amount for taxpayers, compute basic capital gains and losses, access and use various internet tax resources, and lastly, describe the basics of electronic filing, better known as the abbreviated e-filing. So as it relates to the history and objectives of the tax system, since the passage of the 16th Amendment, the constitutionality of the income tax has not been questioned by federal courts. So just to give you a backstory of essentially how income taxes came about. So the first income tax that was ever introduced was during the Civil War, and they had what's called the Revenue Act of 1861. And this is where there was a temporary 3% tax on annual incomes over $800. This act, however, it was repealed in 1872. Essentially, the money obviously dried up. So the government, they came to realize that there was a need for a permanent income tax because, as mentioned, that 3% tax to fund the Civil War, it was just temporary. So one of the issues is that they realized that there was industrialization. There were a lot of big corporations that were being built up, and there was wealth inequality. So there were two major court cases for those of you that love research. The first court case is Wilson-Gorman Tariff Act of 1894. And the Pollock versus Farmers Loan and Trust Company, 1895. And these two court cases, they essentially played a pivotal role in shaping the federal income tax system that we know today. So obviously, there's a lot of backstory behind those two court cases. The 16th Amendment, however, essentially made it legal. So sometimes you'll hear, persons, they'll say taxes are not constitutional. Actually, it is. All right. So with the 16th Amendment, again, it was proposed in 1909 and it was ratified on February 3rd, 1913. And this established a permanent legal income tax system. So, this is what the 16th Amendment states. It says Congress shall have the power to lay and collect taxes on income from whatever source derived without apportionment among the several states. So just to gain some clarity on that, we're learning about federal income taxes. States, they essentially handle taxation in a different way. So that's one of the key things to essentially keep in mind. Why is that very important? Because there are some states that do not subject their residents to taxes. So you just want to keep that in mind. And again, although these states, they don't necessarily tax the residents, there are, some other taxes that they will essentially impose. And as you get into taxation, for those of you who do want to venture into a career in taxation, you'll learn a bit more about that. So the purpose of income taxes, sometimes people, they have a mindset that taxes is just paying the high government employees and they're stealing. And yes, unfortunately, we do live in a world where there's a lot of corruption. Unfortunately, we can't escape it, but us paying income taxes has a lot of benefit to the community as a whole, depending, where you live, a lot goes into it. But some of the main purposes of the income tax is to raise revenue, to help stimulate the economy. So it helps to reduce unemployment, expand investment in productive capital assets. So this applies to, businesses. It helps to control inflation. It encourages certain business activities and goals, and it encourages taxpayers to undertake certain social goals. So one key thing, as we can think of it on an individual level, so for individuals that own a home, they're able to write off their mortgage interest. If you make contributions to a qualified organization, you get to write off charitable contributions. So when tax law is being made, there's a lot of consideration that goes into it. So as it relates to the reporting and taxable entities, we have the individual. So most individual taxpayers, they file what's called Form 10 1040. So under the U.S. tax law, there's 5 basic tax reporting entities. We have individuals, which are you and I, corporations, partnerships, estates, and trusts. So the most familiar taxable entity is the individual. And the most basic form that you will see is Form 1040. And depending on an individual's situation, you might see what's called Form 1040 NR. These are for non-residents. And then 1040 SR for seniors who are above a certain age. They file a more simplified form, but at the very basic, you will file what's called Form 1040. And then in addition, depending on a person's situation, it might also contain 3 possible schedules. We have Schedule 1. And the purpose of Schedule 1, it's additional forms of income other than wages, interest, dividends. Let's say maybe the individual had a distribution from a qualified retirement plan. Then they would report that income there. Social Security benefits, if there's capital gains and losses, along with many of the deductions for adjusted gross income. Next, we have what's called Schedule 2. And the main purpose of this schedule, it reports additional taxes beyond the basic income tax. So we have an additional tax that's called alternative minimum tax. If there's any repayments of excess for the advanced premium tax credit. So those are for individuals who have health insurance through the marketplace. There's also what's called self-employment tax, household employment tax. So those additional taxes will be reflected on Schedule 2. And then on Schedule 3, this is where credits and payments other than withholdings. This includes education credits, the credit for child and dependent care expenses, residential energy credit, estimated tax payments. If someone works multiple jobs and they have excess Social Security taxes withheld, in addition to the net premium tax credit. So again, let's say an individual, they have no additional taxes. When you file their tax return, you won't see a Schedule 2. So obviously, it ultimately depends on the taxpayer's situation. There's certain types of income and deductions that are reported on specific schedules. So in addition to Schedules 1, 2, and 3, as we just mentioned in the previous slide, there's certain types of income and deductions that are going to be reported on specific schedules that are included with the Form 1040, Form 1040-NR, or Form 1040-SR. Schedule A, this is where you would report itemized deductions, which includes medical expenses, certain taxes, interest, charitable contributions, and other miscellaneous deductions like casualty, theft, and loss. Schedule B, this is where you would report dividend income and interest income greater than $1,500. Schedule C, this is to report trade or business income. So this is essentially for a sole proprietorship or for a single member LLC that is treated as a disregarded entity. They would also use this Schedule C. Next, we have Schedule D. This is to report capital gains and losses. Schedule E, to report rental and royalty income or pass-through passive income. So some other types of passive income would be income from partnerships, S corporations, estates, and trusts. And just to ensure that you understand the difference, let's say you're working a job. If you don't go to work, you don't get paid. So going to a job, that's essentially a form of active income. You are actively working to earn that income versus what we have, passive income. So with the passive income, that would be like a rental property. You have the building and you have tenants there. Maybe you go and you do some regular maintenance, but for the most part, the building in and of itself is what is helping to generate the revenue. Your contribution to earning that revenue is very limited. So that would be an example of passive income. And then portfolio income, on the other hand, that would be like interest and dividends based on essentially the investments that you make. So those are the 3 main types of income: active income, where you're actively working to earn it; portfolio income, which again is essentially income that's based on interest, dividends, etc., based on your investments; and passive income, which is essentially income that you don't need to actively participate to earn anything. And then lastly, we have Schedule F, and this is to report farm or ranch income. The corporation is taxed differently than an individual. So with a corporation, they're subject to U.S. income tax, much like an individual. So individuals and corporations are tax-paying entities. Partnerships, S corporations, on the other hand, these are considered pass-through reporting entities. So corporations, with the changes with the Tax Cuts and Jobs Act, things might change because that tax law is going to expire at the end of 2025. Don't really know what's going to happen, but we'll see. So as of right now, corporations, they're taxed at a flat 21%. So it does not matter if the corporation earns $1 million or they earn $1,000. The tax rate remains the same. Corporations file what's called Form 1120. And for an S corporation, they use Form 1120S. Partnership is a reporting entity, not a taxable entity. So what that simply means, let's say that I have a partnership with my sister. We are 50-50 owners. We file the partnership return to show, hey, the business earned $1,000 of income, net income. And based on that net income, based on the ownership structure, my sister will receive a form that shows her $500 allocated towards her. And then I would receive a form, which is a Schedule K-1, showing my $500. And now when I file my individual tax return, I would report the $500. And from there, I would pay taxes on the income earned from the partnership. The partnership itself does not pay taxes. There are some caveats to that. You know, there's an example if the partners, they contribute property that has appreciated in value, but for the most part, you know, that's when you become more, intricately involved in taxation and you have certain clients. But for the most part, partnerships do not pay any taxes at the entity level. Partnerships will file Form 1065, and this form would report the partnership income or loss and the necessary allocation to the partners. Next, we have the tax formula for individuals. I don't care how long you've been doing taxes. I have over 14, close to 15 years of experience in the profession. Some people have 30, 50, maybe even more years. But this is the fundamental of taxation. You start off with the gross income. From there, you subtract deductions for adjusted gross income. And anytime you hear AGI, that's essentially what it is. It's the adjusted gross income, just abbreviated. Next, we have greater of itemized deductions or the standard deduction. From there, you minus the qualified business income deduction. This is new in light of the Tax Cuts and Jobs Act, the change with President Trump. From there, you get your taxable income. You multiply it by the tax rate, and you use either the appropriate tax table or rate schedule. From there, you get your gross income tax liability and additional taxes. You subtract tax credits and prepayments, and from there you get the tax due or refund. So all of this might seem foreign to you. You might say, this doesn't make any sense. This is just verbiage. So we'll go through these to get a better understanding. And obviously, as you work through problems, as you practically apply what you're learning through preparing tax returns, you'll get a better understanding of how all of the numbers come together. So gross income is essentially all income, unless the tax law provides a specific exclusion rather. So the IRS doesn't necessarily define gross income, but what they do say is all income from whatever source derived. So I am a U.S. citizen. My family is from Guyana. Let's say, I start a business out in Guyana and it's earning income. Let's say for the year we had profit of $50,000. A person might think, hey, you know what? That's out in Guyana. I'm here in the US. I'm not going to report it. Uncle Sam ain't having that. So essentially, again, based on what the Internal Revenue Code states, it says all income from whatever source derived. Doesn't matter that I earned that income in Guyana. I am a US citizen. And as a US citizen, I have a responsibility to report that income on my tax return. Doesn't matter. But the most basic kind of income that's reported directly on Form 1040 would be wages, working a job, interest, dividends, pensions, Social Security, capital gains and losses. And then from there, we move on to deductions for adjusted gross income. So the first category of deductions, it includes deductions for AGI. So this would be for certain trade or business expenses. So for sole proprietorships and the single member LLC, as well as certain reimbursed employee business expenses. So there is a bit of nuance regarding the unreimbursed employee business expenses because of the changes with the Tax Cuts and Jobs Act. So we might revert to allowing it in the tax law, but we'll see what happens. Next, contributions to qualified retirement plans and any penalty on early withdrawal from savings. These are considered deductions from AGI. Next, we get to that magic number, which is the adjusted gross income. So the adjusted gross income, the AGI, is the basis for several deduction limitations. So when we think about getting credits, certain credits, they are subjected to a phase out. And based on the phase out, based on your AGI, that determines how much of that credit is going to phase out. When you apply for student loans or you apply for FAFSA or certain things, most times when they ask you for your information, they're asking you on your Form 1040 for whatever the year is, what was your adjusted gross income amount? So that's why, as it states here, sometimes referred to as the magic line. Next, we move on to what's called the standard deduction or the itemized deductions. So one key thing to keep in mind as we are considering these standard deductions or itemized deductions, I like to, make it practical. So as it relates to the standard deduction, think of it as an amount of money that the IRS, Uncle Sam, lets you keep tax-free, right? So based on that, doesn't matter. As long as you're, have an obligation to file a tax return. If you are single, $14,600. So even if you only earn $14,700 and you're single, $14,600 is automatically not taxable, which means your taxable income is only $100. If you're married filing jointly, that amount is doubled. It's $29,200. Married filing separate, it's $14,600. Head of household, $21,900. If you are a surviving spouse or a qualified widower, $29,200. All right. So again, standard deduction, just think of it as an amount of money that the IRS allows you to keep tax free. And another thing to keep in mind is that taxpayers, if they're over the age of 65 years old, they get an additional standard deduction amount. So that's something very important to keep in mind. And with the filing statuses, there are 5 filing statuses. So just to give you a brief overview, single, obviously, that simply means that you're unmarried at the end of the year. Married filing joint, it means what it says. You are married and you're filing a joint return with your partner. Married filing separate, again, it means exactly what it says. You're married, but you're filing separately from your spouse. Head of household, that is essentially a person that is unmarried, but they have a qualifying dependent, as we'll learn a little later. And there are some nuances, for individuals that are married, but they lived apart from their partner for the last 6 months of the year. They have what's called the abandoned spouse. And in those cases, even though you're married, you technically can file the head of household. And then lastly, surviving spouse. This is if you were married and your spouse passed away and you have a qualifying dependent. In such case, you still get the benefit of having the same standard deduction as if you were married 2 years after your spouse passes away. So next we have some exemptions. So prior to when you see TCJA, that stands for the Tax Cuts and Jobs Act. So prior to the Tax Cuts and Jobs Act, taxpayers received a deduction called an exemption for themselves, their spouses, if they were married filing joint, as well as their dependents. The exemptions were suspended starting in 2018, and as mentioned previously, they are going to end in 2025 this year. So we'll essentially see what happens. The exemption amount, which is still used for some limitations, such as the gross income tax for a qualifying relative, is $5,050 for 2024. As we get to the gross tax liability, it's obtained from the tax table or by using a tax rate schedule. Tax credits and prepayments From there, they're going to be subtracted from the gross tax liability to determine, hey, does this taxpayer have a balance due, or is this taxpayer owed a refund? Who must file? So there's several conditions that need to exist before a taxpayer is required to file a U.S. income tax return. So these conditions, they relate to the amount of the taxpayer's income as well as the taxpayer's filing status. So here we see this image, and it basically, summarizes those requirements. So if the filing status is, and here we see the 5 filing statuses listed, and at the end of 2024, you were under 65, 65 or older, and in such cases, then you need to file a tax return if your gross income was at least ... All right, so as we see here, there's a bit of wiggle room if you're single, married, filing joint, head of household, qualifying surviving spouse. But if you are married, filing separate, as you see here, if your gross income was at least $5, a tax return needs to be filed. If a parent or someone else can claim you as a dependent, you still may have to file a return. So for example, let's say there's a single dependent, they're not age 65 or older or blind, they need to file a return if any of the following apply. So if their unearned income was over $3,250, and if their earned income was over $6,550. So if their gross income was more than the larger of $3,250, or their earned income up to $14,150 plus $2,400. So we have what's called kiddie tax that kind of ventures into that, which we won't cover in this chapter, but there are certain cases where there are children that have brokerage accounts opened on their behalf, or like child models and things of that nature, where even though they're, young, they're earning income. So there might be certain instances where the child, even though they're a dependent, they still need to file a tax return. And there's several other conditions that's based on age, earned/unearned income level, married or single, and if the dependent is blind, determine whether the dependent needs to file. And there's some other situations where you might need to file a tax return. So if you owe any special taxes, such as Social Security and Medicare taxes on tips. So in these situations, your gross income might be less than what was reflected on that chart, but because you meet the criteria of one of these specific situations, you still need to file a tax return. If an individual needs to pay alternative minimum tax, the AMT tax, tax on an individual retirement account, recapture of taxes of the first-time home buyer credit, if the taxpayer or their spouse, if filing jointly, if they received a health savings account, an HSA, an Archer MSA, or Medicare Advantage MSA distribution, so medical savings account, if they had net earnings of $400 or more from self-employment. So let's say someone is single. If we refer back to the chart, here it says, if your gross income was at least $14,600, let's say someone started a business and their net income was $1,000, Uncle Sam says, hey, you know what? I know your gross income was not more than $14,600, but guess what? You had net earnings of $400 or more. Therefore, you need to file a tax return because you owe us self-employment taxes. Okay, Uncle Sam don't play that. You needs to report it. Next, if the individual had wages of $108.28 or more from a church or qualified organization exempt from Social Security and Medicare taxes, if there were any advance payments of the premium tax credits that were made on behalf of the taxpayer. So again, this is essentially where the taxpayer receives health insurance through the marketplace and they receive advance payments. And lastly, if they're required to include income amounts under Section 965. So finishing up with who must file. You must file a hard copy at the IRS campus processing site or e-file. So what this simply means, there's two options. Individuals can paper file it or they can e-file it. We live in a day and age where practically, I don't want to say all, but a great majority of returns are e-file, but there are situations where an individual cannot electronically file a return. Simple example, let's say fraud, right? So if you try to file a tax return and the IRS already has an electronic copy of that tax return with your social security number, you can't process it again, right? I've had instances with clients where that happened. Someone filed a fraudulent return on their behalf. So now we can't file it because every time we file it, the IRS is giving us a rejection that we already have a tax return on file with the social security number. So in such case, we would need to mail it. So generally, tax returns, they're due the 15th day of the 4th month of the year following the close of the tax year. So what that simply means, tax returns are due April 15th each year for the year prior. So very important to keep in mind as it relates to taxes. Taxes are done retroactively. So if you are in 2026, you are filing taxes for 2025. If you are in 2025, you are filing taxes for 2024. So it is retro. All right. You're looking back. And if the 15th, let's say it falls on a weekend or, it falls on a holiday, then the returns are going to be due the next business day. There are two exceptions in Maine and Massachusetts. Patriots Day may fall on the 15th. Thus, the returns are not due until April 16th. In the District of Columbia, D.C., Emancipation Day is observed on April 16th, and if it falls on a Saturday, then it is observed on April 15th, and thus the filing day, the deadline, would be extended in such cases. So next we move on to filing status and tax computations. We covered this a little bit, the 5 filing statuses. So a single filing status, again, this is someone that is unmarried or legally separated as of December 31st, and they're not qualified to file as married filing separate, head of household, or surviving spouse. Next, we have married filing joint. So if the individual is married on December 31st, even if they don't live together the entire year, and if the spouse dies during the year, they file as married filing jointly in the current year. So with this second bullet point, I had a client, it was a few years ago. Her husband passed away January 1st, maybe around like 8 or 9 a.m. in the morning. So based on this rule, it says if the spouse dies during the year, file as married filing jointly in the current year. So even though the spouse was only alive for, let's say, 8 or 9 hours into the new year, that taxpayer was able to file their tax return as married filing jointly. Let's say someone gets married on December 31st. They were single all year. However, because as of December 31st, that individual was legally married, therefore, they can file as married filing joint for the entire year. Next, we have married filing separate. That's where you're married, but both spouses, for whatever reason, they decide to file a separate return. They need to compute taxes the same way. That's one of the nuances. And with married filing separate, sometimes you lose certain credits. So if you file married filing separate, both spouses need to take itemized deductions or both take the standard deduction. It cannot be a difference. And if you're living in what's called a community property state, then they must follow the state law. Next, we have head of household. So this is an individual that is unmarried. However, they have a qualifying dependent, the qualifying dependent. So with the head of household, this is unmarried, or as mentioned, we have what's called the abandoned spouse. So this is a taxpayer that's married, but they didn't live with their spouse for the last 6 months of the year. In addition, they need to pay more than 50% of the cost of upkeeping a home that was a principal place of residence for a dependent child or other qualifying dependent relative. So there's one exception to this principal residence requirement. If the dependent is a taxpayer's parent, the dependent does not need to live with the taxpayer. So obviously there's some nuance. So that's why for those of you who want to venture into tax preparation, you have to ask the right questions, right? It's not necessarily your job to validate what the client is saying, but you're filing his tax return. And the fact that you are signing off on his tax return, and there are what's called, due diligence. So before clients can get certain credits, you have to go through an entire checklist to say, hey, did you ask this client this question? And if you did ask them, what kind of proof did you get? Was it verbal? Was it written, etc.? Because you're signing off on it. You don't want to be held liable for not asking the right questions. Next, we have surviving spouse with a dependent child. So again, this is where you were married and the spouse died. You still get the benefit of the joint tax return rates for 2 years after the death of the spouse. And in order to qualify, you use the joint return rates. The surviving spouse must pay over half the cost of maintaining the household where the dependent child, stepchild, adopted child, or foster child lives. And as it relates to the 7 tax brackets, so sometimes people get it confused. They think that it's just one flat tax rate. It does not work that way. So we have what's called a progressive tax rate. Individuals, they pay a progressive tax rate. So what that simply means is that the more income you earn, essentially, the more taxes you pay. So think of it like buckets, right? If you have, 5 buckets, see if I can annotate. Let's say you have my handwriting isn't the greatest, but we got to make this work, right? 1, 2, 3, 4, 5, 6, and 7. All right. So let's say you're being taxed at a 22% tax bracket for whatever the threshold is, whatever the range is, you'll be subjected to that 10% for that first amount. Let's just say, for illustration purposes, the first $1,000 would be taxed at 10%, at 10%. The next 11,000 will be taxed at 12%. And then the next, let's say 15,000 will be taxed at 22%. So for the year, you earned $27,000. And of the $27,000 that you've earned, the first 1,000 is going to be taxed at the first tax bracket. The next 11,000 will be taxed at 12%, and the last 15,000 is taxed at 22%. So that's essentially how it works. It's not that all 27,000 is going to be taxed at one bracket. And then obviously, if you start to earn more money, let's say instead of 20,000, the person earned 30,000. Then in such case, the next 3,000 would be taxed at 24%. All right, I will figure out how to master this, writing, but hopefully that helped to make sense. Okay. All right, so these are the 7 brackets based on the income level. Start off at 10%, 12%, 22, 24, 32%, 35%, and then 37%. So the ranges, obviously, it ultimately depends on your filing status, and that ultimately determines rather what the income ranges are. Next, we move on to qualifying dependents. So as mentioned, prior to Tax Cuts and Jobs Act, prior to 2018, taxpayers, they were able to deduct an exemption amount of approximately $4,000 for themselves, their spouse, if married, filing joint, and any dependents. But these exemptions, they're no longer available. Instead, there's now an increased standard deduction. Dependents, they are important, obviously, for credits and the head of household status. The suspension of the personal and dependency exemptions, it's scheduled rather to expire after 2025. So the standard deduction amounts may return to being reduced, and then the exemptions will also return. But like I said, it's up in the air. We'll see what happens. As it relates to qualifying child, so there's some key things requirements that need to be met, tests to determine if the individual is a qualifying child. So there are 4 tests. The 4 tests is a relationship test, next, a domicile test, the age test, and the self-support test. So to be a qualifying child, they need to meet not 1, 2, 3, or 4. They need to meet all 4 of these tests. So as it relates to the relationship test, the potential qualifying child, they need to be the taxpayer's child, their stepchild, adopted child, the taxpayer's brother or sister, half brother, half sister, step sibling. They could be a descendant of these. And in certain cases, a foster child can also qualify. Next, with the domicile test or domicile or the abode test. So what this simply means is that the potential qualifying child, they need to have the same principal place of abode for more than half of the taxable year. So they basically needed to live in the same home. There are some exceptions though. Keep in mind, if there's temporary absences, so let's say maybe there's an illness or education. So if a child is away from school, that is one of the exceptions. Let's say there's a vacation, there's a birth, a death of a child, and things of that nature. Next, we have this age test. So the potential qualifying child must be under the age of 19. If they are over the age of 19, they need to be a full-time student under the age of 24. And as it relates to that potential qualifying child being considered full-time, that means that they need to be enrolled full-time for at least 5 months of the year. Lastly, we have the self-support test, and this is when a potential qualifying child provides more than one half of their own support. They can't be claimed as a dependent of someone else. So support includes, expenditures for items such as food, lodging, clothing, medical, dental care, education, etc. So in some cases, the child might be, providing more than half of their support. So based on that fact, unfortunately, they cannot be treated as a qualifying child. So we have this question here. What if the child meets the dependency requirement for more than one taxpayer? So unfortunately, sometimes we see this in instances where, let's say the parents are not yet divorced, but they're separated, or the parents are divorced, and then they essentially, the child lives with one parent for 6 months and then the other parent for 6 months. So in such case, there's obviously some tiebreakers. There's some rules surrounding who is going to be able to claim the child. So if one of the parties is a parent, then that person, the parent, would claim the child. If both parties are parents and they don't file jointly, then the parent with whom the child resided for the longest period of time or the longer period of time during a year, they can claim the child. If they can't necessarily determine, like, I don't know, the child lived here for 6 months, there for 6 months, we don't know. So here it says, if it's not ascertainable, then the parent with the highest AGI may claim the child. If there's no parents involved, then the person that has the highest AGI can claim the child. And if a parent can claim the qualifying child but does not, in such case, the individual with the highest AGI can claim the qualifying child, but only if that individual's AGI is higher than the AGI of any parent that could have claimed the child. So obviously, there's a lot of nuance that goes into this. There's a lot, as I mentioned, I've been doing taxes for over 15 years, and there's a lot of crazy stuff that I've seen, with people claiming children that are not theirs. It's not pretty, okay? Because you definitely don't want the IRS to come knocking to provide proof of the child. It's not a fun time. Next, we have qualifying relatives. So with a qualifying relative, this is a person who's not a qualifying child, but they might be considered a qualifying relative. So the potential qualifying relative, they need to meet the first 4 tests for all dependents outlined earlier. The taxpayer can't be claimed as a dependent. And a potential qualifying relative, they can't be filing jointly, they can't be married, they need to be a U.S. citizen or resident alien, and they must have a taxpayer identification number. So this is the basis for all dependents. These 4 requirements must be met first. And for the qualifying relative, we have the relationship test, the domicile, abode test, the gross income test, and the support test. And the reason why this is important is because you get credits for children and other dependents. There's, obviously some significant tax credits that are available. Hence why sometimes, I've seen it in the profession, especially in cases where there's a child involved and the individuals are not married. Sometimes one individual, they're rushing to file and claim the child first because let's say, they file the tax return first, they get the child tax credit. Now the other parent tries to file it, their return is going to get rejected from the IRS, and it's going to say, hey, we already received the return with the social security number for this dependent. So now the individual, either they're going to have to fight the case, they're going to have to paper file it, take it up with the IRS to prove I legally should be able to claim this child, or they'll simply need to remove the child as a dependent and be treated as single or have one less dependent on their tax return. A tax credit differs from a tax deduction. So this is definitely important to know. Why? A tax deduction, it serves to help lower the taxable income of the taxpayer. A tax credit, on the other hand, it is a dollar for dollar reduction of tax liability. Thus, a credit is generally more advantageous than a deduction. So as of right now, this might be like, what? Doesn't really make sense. It's not sticking. As we continue to go through the other chapters and learn more about the various aspects that make up taxation, you'll start to understand it a bit more. Next, we just, move on a little bit more with the standard deduction. We covered this already. It is basically an amount of money that the IRS lets you keep tax-free based on your filing status and your age. So for single individual, we went through these numbers already. These are the amounts for 2024. Just keep in mind, these amounts are adjusted each year based on inflation. And obviously, based on the inflation amounts, that determines what your filing status is going to be. So these are the amounts for 2024. For 2023, the standard deduction amounts were slightly a little reduced because, as mentioned, they are essentially adjusted each year for inflation. So for last year, 2023, the standard deduction for a single individual was $13,850. For married filing joint, it was $27,700. For married filing separate, the standard deduction amount was $13,850. For a head of household, it was $20,800. And lastly, for surviving spouse, the standard deduction was $27,700. And then as mentioned, there are some additional amounts for old age and blindness. So in 2023, the additional standard deduction amount was $1,850 for unmarried taxpayers and $1,500 for married taxpayers and surviving spouses. As we see, there's an adjustment for inflation for 2024. The additional standard deduction for unmarried taxpayers, blind, or over the age of 65 is $1,950 and $1,550 for married taxpayers and qualifying widows or widowers. There are some individuals that are not eligible to take the standard deduction. So taxpayers cannot use the standard deduction and must itemize if they are married filing separate and the spouse itemizes as mentioned. If you file married filing separate, both of you need to do the same thing. If you are a non-resident alien, and if you are an individual filing a short period tax return because of change in the annual accounting period. In such cases, you cannot claim the standard deduction. And there are some special limitations for dependents. So the standard deduction is limited for the tax return of a dependent. So this is where we were essentially discussing the kiddie tax. So in that type of situation with kiddie tax, and we'll see an example on the next slide, the total standard deduction, it cannot exceed the greater of $1,300 or the sum of $450 plus the dependent's earned income up to the basic standard deduction amount of $14,600 plus any additional standard deduction for old age or blindness. So this is in the realm of kiddie tax, where a child, they're young but they're earning income. So in this example we see here, as a child, model 8-year-old Pencer earned $17,000. He is claimed as a dependent by his parents. How much is his taxable income? So the solution is his earned income, which is $17,000, minus the standard deduction, $14,600. Taxable income in such case would be $2,400. So this is where there's earned income, active income, as we discussed earlier. Now, in this case, we have Geoffrey. He's a 4-year-old, claimed as a dependent by his parents. He earned $6,500 in interest income from a large bank account left to him by his grandmother. How much is his taxable income? So in this case, he has portfolio income. So he has interest income, and it lets us know that it's $6,500. And from there, we minus the standard deduction of $1,300. So therefore, Geoffrey's taxable income would be $5,200. So ultimately, it depends on the type of income earned. Is it earned income or unearned income, which is, the example in this case, which is why the standard deduction is $1,300. So this is a very nuanced area of tax law. You might see it. For those of you that want to venture into taxation, you'll mostly see this when you deal with high net worth clients. If you're dealing with clients that are middle class for the most part, low income, you won't necessarily see the kiddie tax. You more so see this when you're dealing with high net worth clients where they're, strategically shifting income, putting brokerage accounts into the names of the child because, they're subjected to lower tax rates. Next, we move on to a brief overview of capital gains and losses. So whenever a taxpayer sells an asset, there's going to be a gain or a loss in a transaction. That's just the nature of things. So let's say I purchased a pair of sneakers for $200. Used to be really into sneakers, OG Jordans. It was a whole long phase, right? But OG Jordans, right? So let's say I purchased these olive nines for $200, and and these are not the resale, because sometimes they brought back Jordans, they remade them, right? But let's say they were a classic pair of Jordans. Oh, I have a great one, Laney 14s, right? I have a pair of these Laney 14s or Cherry 16s. I still have some Jordans that they were never resold. I have the original, right? And let's say I paid $200 for them. There's some real sneakerheads out there that'll be willing to say, hey, you know what, I'll pay you $800 for those sneakers. Hey, I bought it for $200, I'm selling it for $800. That means that I have a profit of $600. Uncle Sam don't play that, okay? You need to report it on your tax return. So that's essentially the nature, right, of capital gains and losses. Whenever the taxpayer sells the asset, the type of asset determines the tax consequences. So we're talking about sneakers, right? But what about selling stocks and bonds? What about selling a home? What about selling a car? So the type of asset you sell, that determines the tax consequences. So the formula for calculating the gain or loss, it can be stated as follows. Gain or loss realized is based on the amount realized, which is the cash you received minus any selling expenses minus the adjusted basis. So as we see here, the amount realized is generally the sales price less any cost of the sale. Most gains and losses realized are also recognized. So it's very important to distinguish between the two. So realized means that, hey, okay, there was an increase or there was a profit more so. So to make it more understandable, realize versus recognize, I'll use an example with real estate, right? So let's say I have a home. My home is $100,000 and it increased in value to $200,000. So there's a realized gain on the property of $100,000, right? But imagine how crazy it would be if Uncle Sam now says, hey, you need to pay taxes on that $100,000 because you have a realized gain of $100,000. The property was purchased for $100,000 and now it's valued at $200,000. What? If that's the case, a lot of people probably wouldn't want to own a home, right? So recognize, on the other hand, means that there's a transaction that took place that solidifies this sale taking place. So what that simply means is, okay, yes, I purchased a home for $100,000 and now I'm selling it for $200,000. So in such case, that gain would be recognized, and recognized simply means that it is reported, it is included in the taxpayer's income. So hopefully that helped. When we see this in another chapter, we'll go into more detail. So capital gains and losses. A capital asset is any property, either personal or investment, held by a taxpayer with certain exceptions as listed below. So for example, stocks, bonds, land, cars, boats, and other items held as investments or for personal use. Capital gains and losses, they receive special tax treatment. So if it's short term, that means it is held for 12 months or less. Capital gains are taxed at ordinary income tax rates. And if it's long term, that means it has to be held for more than 12 months. The capital gains are taxed depending upon the taxpayer's tax bracket. And just one quick note. So if you purchase a property April 1st, 2025, and you sell it April 1st, 2026, that's considered short term. It's exactly a year. So essentially, when we're dealing with capital assets, or rather determining short term and long term, you do not include the acquisition date. So in order for that asset to be treated as long term, we don't consider April 1st. We would need to sell that asset after April 2nd in order for it to be considered long term. So the tax rates on long-term capital gains are as follows. And again, it depends on the income level. If you're married filing joint and your income is between $0 and $94,050, $0 on capital gains rate. If your income falls between 94,501 to 583,000, 15%. If it's above 583,750, then it goes up to 20%. So for some, this might be like, wow, this is still a lot. Hey, if you think about it, the highest tax bracket or tax rate went up to 37%. So with this long-term capital rate, let's just say that the individual is a high net worth client and their income is over 583,000, they're saving 17% for every dollar of their capital gains rate, right? So this is for single head of household, married, filing separate. So again, this is a great provision in the tax law. There have been some talks about doing away with it or reducing the amounts. We'll see what happens. Next, we see the brief overview, finishing up with the brief overview of capital gains and losses. Long-term capital losses, they're only allowed $3,000 per year against ordinary income, and you can carry forward any unused balance. So just a key thing to keep in mind, there is a difference between ordinary income and losses and capital gains and losses. So capital gains, if it's long-term, it's treated favorably. Ordinary gains, they're subjected to ordinary tax rates. Capital losses, they're subjected to $3,000 per year. So let's say someone sold stocks and they had a loss of $9,000. $3,000 is the maximum you can claim each year. So it would take you 3 years, assuming there's no other stock transactions. It would take 3 years to write off that $9,000 loss, versus if it was an ordinary loss, you get to write the entire thing off in the year of the loss. So there are some nuances between capital gains and losses and ordinary gains and losses. Next, we move on to tax and the internet. So in this section, taxpayers and tax practitioners, obviously, they can find a substantial amount of useful information on the internet, right? We live in this day and age where we're technology driven. There's even Chat GPT, but disclaimer on Chat GPT, because sometimes Chat GPT is not always accurate. Okay. The other day I went to drop someone to the airport and they, plugged in, hey, which terminal is Frontier Airlines at JFK? And they got a terminal, but it was incorrect. And then when I did my own Google research, I see where Chat GPT pulled the information, but it was wrong. It was inaccurate. Okay. So you want to use, certain things with caution. The IRS website, this is one of the most useful websites containing tax information. This allows the user to conduct common tasks such as check for their check refund status or make a tax payment. There's also forms and publications. There's a search function that allows the user to download tax forms, instructions, and publications that are available from the IRS. And this is a great tool for those that want to venture into the field of taxation. Let's say, you're like, hey, you're dealing with a client. There's times where I'm looking at a form for the first time ever, and I've been doing taxes for over 15 years. Tax law is so vast that it is impossible for you to know everything, right? But the great thing is, let's say I'm dealing with a new form. I've never seen this form before. I'll go to the IRS website, get the publication, the form instructions, and I'll read through the lines and it'll tell me, hey, okay, this is the purpose of the form. This is who needs to use the form. And it gives you details about the instructions
per line item, essentially. And then, if you still don't understand it, you can call the IRS. Then we have a special tax practitioner hotline where you can call someone for advice. Sometimes the person on the other line, they don't know what you're talking about. So another great benefit, you connect with colleagues, you speak, and you get some interpretation that way. All right, but the IRS website is a good starting point. The IRS has also launched a YouTube video channel that features numerous educational videos covering a number of tax-related topics, including how to obtain a refund or how to file a tax return extension. X, formerly known as Twitter account, the IRS has one, includes various news feeds. IRS has a LinkedIn, Instagram, Facebook page, and IRS also has a mobile application, IRS to go. Next, we have Intuit Pro Connect Tax Online. So there's certain, companies that offer tax preparation products. So there's a plethora of tax softwares. There's Pro Connect Tax, there's Lacert, there's TurboTax, there's Drake Tax, there's Ultra Tax, there's ATX. I mean, there's just a number of tax softwares. Ultimately, up to the tax practitioner and their budget, what they can afford. If you're first, starting out, generally the firm that you work for, they'll be the one responsible for, purchasing the tax software. Next, we have Tax Notes. Tax Notes is a portfolio of publications offered by tax analysts, a nonprofit publisher fostering free, open, and informed discussion about taxation. The entire Internal Revenue Code, also referred to as the IRC, and the related regulations, revenue rulings, revenue procedures, and an extensive repository of tax-related court cases are available for free 99, no cost. Next, we have ChatGPT and artificial intelligence. So the advent of new artificial intelligence AI technology is likely to change the way tax preparers find answers to client tax questions in ways that cannot yet be imagined. Recent improvements to ChatGPT increase this accuracy, but as mentioned, all responses need to be confirmed by primary sources before relying on them, because sometimes technology gets it wrong, okay? All right. Next, we have electronic filing. As mentioned, there's two methods of e-filing, or two methods of filing, rather. Paper filing, the traditional old school way, and then we have electronic filing. So there's two methods of e-filing. You could use a personal computer device in a tax preparation software, or you can use the services of a paid provider, such as a certified public accountant, enrolled agent, a tax attorney who employs the IRS tax professional e-filing program. So more than 90% of all individual taxpayers are now e-file, and mandatory e-filing required for most professional tax return preparers. It just makes everything so much more streamlined, much faster. Generally, when returns are paper file, they can take between 14 to 16 weeks. Okay. So that's like 4 to 6 months just to get the tax return process, versus e-filing. You submit it and you can get an acceptance within hours. Okay. So generally, most returns are e-file, with the exception of certain instances where you cannot. Now that brings us to the end of chapter 1, the individual income tax return. So now that this lesson has ended, you should have learned how to explain the history and objectives of U.S. tax law. As we learned, the first taxation was enforced with the Revenue Act of 1861, but it was repealed, and with the passage of the 16th Amendment, now income taxes being imposed at a federal level is constitutional. We described the different entities subjected to tax and the reporting requirements, where we talked about individuals, corporations, partnerships, estates, and trusts. We applied the tax formula for individuals. We start off with gross income, subtract those deductions, get our AGI, standard deduction or itemized. From there, we get our taxable income. And based on the credits, the prepayments, and the taxes, that ultimately determines, does this client have a balance due, or are they owed a refund? We identify the individuals who need to file a tax return based on their filing status, their income, and then we also learned that there are some special situations where individuals need to file a tax return even if their gross income is below the threshold. We determine the filing status and understand the calculation of tax according to filing status. As we know, there are 5 filing statuses: single, married filing joint, married filing separate, head of household, as well as surviving spouse or qualifying widower. We define qualifying dependents. It's either they are a qualifying child or a qualifying relative. We calculated the correct standard or itemized deduction amount for standard taxpayers. Again, the standard deduction, think of it as an amount of money the IRS lets you keep tax-free. Itemized deductions includes a list of personal expenses that Congress allows. This includes medical expenses, charitable contribution, taxes, interest, etc. There are some limitations, as we'll learn. We computed the basic capital gains and losses and also learned the difference between capital gains and losses versus ordinary gains and losses. We learned how to access and use various internet tax resources. There's the IRS website. They have tax notes, chat GPT, and artificial intelligence, and also, the professional tax software that are out there. And then lastly, describing the basics of electronic filing, better known as e-filing. So this brings us to the end of the PowerPoint presentation for Chapter 1, the individual income tax return.